First off, looking at the markets right now, the United States, U.S. market coming off of excellent 2013. We're a little down a little bit on the year right now, but not a big deal. One thing you will hear about, and I did want to mention it more as please take this more as entertainment as a fact, but there's something called the January barometer, and it's like if whatever happens in January statistically happens for the year. For example, if the S&P 500 is up in January, then 80% of the time the market is positive on the year, with the average return being 13%. When January is down, there's only a 42% chance that the market will be positive by the end of the year, and 66% of the time we will have an average return of about minus 2.3%. I don't put too much stock in it. Take it as entertainment. Right now, the U.S. market's down a little bit. It's down a percent or so on the year. Not a very big deal. Overseas is having a little bit of problems. Emerging markets especially are down an average of 6.5% this month, which is pretty big. And these markets were all down in 2013 as well. At some point, we do think they do have to rebound, or something has to give. Either the U.S. is going to come down a little bit, or emerging markets are going to catch up. We're going to have to see what happens. Right now, gold had a lousy year last year because there's no real concerns of inflation, and until inflation if inflation doesn't become a problem, then I don't think gold is going to get inflated at all. Finally, bonds. The one thing I do want to mention, and that's where I've reallocated some money this year, is bonds. The bond market really did have a lousy 2013, and that's because we saw a spike in interest rates halfway through the year. Since then, interest rates have steadied and remain pretty stable, and I feel more comfortable putting money back into that area. For the non-IRA accounts, we've bought some municipal funds. These funds are averaging about a 6% dividend, and they've all appreciated in the month. So, I'm comfortable holding them as long as interest rates stay where they are, and they're giving off very nice yields. For the IRA accounts, we've bought Build America bonds, which are yielding a little bit less at 5%, still very good considering this interest rate environment. And we're also, on both sides, I've bought floating rate bonds. Floating rate bonds are designed to stay very short in duration, because if interest rates spike, the bonds that have longer duration get hurt the most. Perfect example is the 30-year Treasury bonds. If you owned them last year, you lost about 20%, and that's a lot of money for a bond. And considering interest rates only went up about a little more than 1%, but that's the world we're living in with low interest rates. If they do go up, long bonds are going to suffer. That's why we're owning the floating rates. They're paying about 4.3%. If rates do rise, we'll be protected there, and if rates fall, the floating rates will be pretty stable, still give you the yield, and our other bonds will do well. Right now, I think that's probably the best way to go for the next couple of months unless we see any changes, and if we do, then I'll reallocate at that time. In the meantime, please give me a call if you have any questions. I know I've already seen a lot of you for a review and spoke to you, and would love to see the rest of you. Have a wonderful day. Thank you.